We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is returning guest Mark Magarian, Senior Portfolio Manager at Pine Valley Investments, where he manages a value fund focused on hard assets and cash flows. Thanks for joining me again today, Mark.
Thanks for having me, Tom. Good to speak to you.
Absolutely. So, the last time we spoke was, to give people some context, just over 2 years ago. And I thought maybe we could begin by asking you, since you've recently made a switch to more of an independent shop, during your time with Deutsche Bank, UBS, Morgan Stanley, and Wells Fargo, what do you think were some of the biggest lessons you learned from your time there?
Well, that stretch covers a long time, about 16 years now. Covers a lot of different types of cycles and a lot of different types of conditions. And I think probably the thing I learned the most was timing is everything. Don't go too fast and wait till you have an edge. But I guess, if you're able to learn from your experiences effectively over time, then, and you manage to survive in this business long enough, then eventually, one likes to think you figure that out. And I'm certainly better at it today than I was back then.
Yeah, I couldn't agree more. Timing is everything. And it seems this macro environment, which we'll get to, is really absolutely essential to understanding to be able to, be successful in this world. So in that vein, is this possibly a transitional time for the world? And is that why you made the switch to running your own fund?
Well, I was always running my own strategy, but I wanted to, an independent platform essentially was going to allow it to remain in its purest form. I think that's the right way to say it. I think when you're working for the big shops, sometimes they like to get their fingers in it. And, my strategy is what it is. And my clients have signed up for a certain amount of integrity, certainly when it comes to, doing things a certain way and following the process, which is, focused on cash flows, balance sheets, buying assets at a discount. And I wanted to be able to do that without interference or any other influence that would affect that. And certainly, Pine Valley is a terrific company with great people, and they have, better infrastructure, to be quite frank, than most of these larger companies. And, they provide the platform for me to be able to continue my strategy without any undue influence, like I said, and to be able to continue to deliver the good results, which have been excellent, to be honest.
So is it maybe partly due to their risk framework that made some of those bigger institutions less appealing for you?
I guess, I could interpret that question in a couple of ways. I mean, I've always felt a little bit nervous working for a bank ever since Bear Stearns and then Lehman, and I've actually never invested in a bank in terms of like a stock investment for any of my strategies. And if anyone's ever asked me about that, I've always gone, well, we've got our money at the bank, so that's long enough for my liking. So, you could look at it that way. But then I guess the other way is that ultimately a lot of these banks, they have very cookie cutter models. Okay. They're looking for someone to do like a 60-40 portfolio, a bunch of Apple in it, and, pick out 10 mutual funds and go to sleep and charge a fat fee. And that's really not what I do. I'm more concentrated. I'm very deliberate. And I typically don't invest in mainstream assets. There's very rarely, a value opportunity to the criteria that I prefer. Really, really big, large cap name that everyone's following at every moment of the day. It sometimes happens. Sometimes there's a setup, but it's rare. So I'm gravitating to, smaller holdings in more niche areas. And, the big banks, don't always get comfortable with this, regardless of the due diligence that I perform. They like to bundle everyone in together in one pot, and they feel comfortable with, and, that's what they want to do, but that's not what I do.
Mm-hmm. So then, Mark, how do you think about your risk management strategy? Obviously, you mentioned your due diligence, but are there other ways that you can think of to manage risk, whether that's maybe buying into a gold miner that also has some silver assets? Is that maybe a decent example of how you think about managing risk?
Yeah, I mean, there are lots of layers to managing risk, and I guess I see risk through some different lenses than maybe other people. and there's advantages and disadvantages to see the world through my eyes. And one of them is that, statistically speaking, a lot of institutions look at risk purely through the lens of sort of volatility, right? And I get it. Yeah, something moves up and down a lot. You think it's risky. But to me, I'm more interested in the cash flows and the price that we're buying the asset. And I think of it as if we were taking this company private. And what would we own at this price? And would we be bothered if the perceived value was going up and down a lot? We probably wouldn't. If I own a handful of private businesses and I don't care what someone's going to pay me for them on a day-to-day basis. I just care about the cash flow and what I think they're worth. So, that's one way that I look at risk in that particular manner. But then alluding to what you specifically said, yeah, I think that there are different companies that have different risk profiles because of their asset bases. And the gold with the silver, there's less, I think, of a diversification there, unless the assets in of themselves are, have something particularly special about them. They're like very low cost, ultra high grade, something like a Kirkland Lake asset or something like that. But, companies which maybe have copper in them, a lot of copper, like a Barrick is, about to do a copper project in Pakistan, right? That probably tickles that particular thought process a little bit more when I'm thinking of diversification, because those at copper can do a different dance and has a different macro story than gold. So, when you have a big part of your portfolio in that department, that certainly is a risk diversifier, I feel.
So, as I said, it's been just over 2 years since we last spoke, and we're just in the beginning of figuring out how COVID was affecting the world and how, really the financial ramifications of central banks' actions would have been to the lockdown. So what has surprised you the most since then? Was it the inflation, the rise in asset prices and housing, or anything that comes to mind there?
Well, I think there's been lots of surprises. This has been, a very unique period in history where, you're trying to compare it to other times and you end up getting a little bit of them all mashed together with something entirely new. So it's definitely been full of surprises. I suppose, some of the restrictions around the world have dragged on for much longer than I could have imagined. China obviously is still operating its zero COVID policy, which seems pretty crazy from where I'm sitting. And certainly, even other countries are only just started to pull back on some of their rules, such as, New Zealand or Canada. So I think that's been a surprise. And, you've certainly seen a lot of different types of political behavior that has been a surprise. A little bit of an insight into human behavior, really. When different extremes present themselves, you start to see governments act in different ways. And right now, obviously, we're dealing with the aftermath of not just, the excess amount of QE the Fed created and other central banks, but then all the money that the government's dumped into people's pockets to keep the train going at the time, which is obviously one part of the inflation equation, but then also the supply side is still affected by so many factors. And hence, you've got this rampant inflation situation on our hands. And yeah, it's definitely been a surprise that it's gotten this ridiculous. But, with what the Fed is doing right now in terms of attempting to fight it, that is proving to be a very interesting situation because, they're trying to talk a very tough game, but in the end, they're going to choke because the market, cannot take the kind of high rates they're talking about for too long. And so it's going to come. You just don't know when and just how bad they're going to allow it to get before they do it. So that's sort of a little bit of game theory to figure out there. But then also the really crazy part of it is, they're acting like their tool alone can cure the inflation problems that we have. And that's really scary because they can't. If when you take into account every factor going on right now affecting this world, which with this global supply chain and all the other it's a lot to compute to put it all together, but they certainly, there are certainly, you could argue they are possibly making things worse in many respects, given that they don't have as much control over what's really going on. So yeah, a lot of surprises, but also a lot of opportunity setting up. I think that the more a market is surprised by different events, sometimes the more dislocation in different asset prices and values you get, which is typically the feeding ground for someone like me to go find something that I think's on sale and then make some people some money.
Mm-hmm. Yeah, I think that's a great way to look at it. Do you think that maybe the crypto craze drew a lot of investment and attention away from the hard assets over the last 2 years?
Yeah, I've always thought that the answer to that was probably yes, but and there's probably is some aspect of that. But, a lot of the people who've dived into crypto, I'm not so sure that a lot of those folks would have been interested in let's say, gold and silver as a monetary alternative anyway. You've got a lot of different types of folks in crypto, let's be honest, right? You've got that kind of younger investor where this is their first foray and they think everyone else is old and who buys stocks anymore? Let's buy, monkey coin or whatever. You've got those guys, right? But then the big players like Novogratz or whomever else, I mean, they're not huge hard asset guys anyway. They're just tech people, really. And this is just another tech investment. And to be quite frank, when you look at Bitcoin's price and much of the others too, it's basically just like a triple levered ETF on the NASDAQ. So I just, there were people who I used to run into to tell me that, oh, it's digital gold or whatever. And it's like, it really isn't. For sure not. But it certainly does not act like it. It's not digital gold. It's levered tech. That's what it is, and that's how it acts. So I think that's been obvious for long enough that anyone who did think that this was the alternative to, let's say, a precious metal investment or something like that, I think that anyone with any money or any brains has already figured out the truth of that. And so if there was anything, any siphoning of interest, I think that's already, it's been and gone.
Mm-hmm. Do you think that maybe this was an important lesson for the average investor about momentum and mania? And do you think that could be instructive in the next run up, or have we seen this new camp really be solidified into one that would never invest in gold or hard assets?
Honestly, I mean, there is a part of this group, the Reddit crowd and, who are already big about silver. They call themselves, the silverback apes or whatever else they've got, and they want to stack. And you've already got a little bit of a crowd there. And, that may be a good segue into silver, actually, because that's at a very interesting moment right here. So you've got a lot of different things coming together on that one. And if you look at the Commitment to Traders report, which for anyone who doesn't know what that is, that's basically a breakdown of the futures market that the futures exchange releases every week, showing essentially, where hedge funds and banks and producers are positioned in their futures positioning. And it essentially shows right now that we're at quite an extreme where the producers and the banks are actually long the silver market. They're not hedged at all, and hedge funds are short silver. And it's gotten to an extreme just on the last report that matches, right about matches some of the most extreme moments in silver's history where it's only been a massive buy, 12 months out. It got like this in at the 2018 low. It looked a little bit like this in 2016. It looked a bit like this at the beginning of the century. And, a lot of the time you get these sorts of indicators work best when they're combined with, a few other factors at the same time, right? So, of course, the whole sector's hated. That's true. You've got, the cost to borrow in some of the silver ETFs has escalated lately, which is another signal that it's getting tight. Inventories at the warehouse, the registered inventories that are used for delivery of silver have slowly been going down just over the last year. And there are factors of that. Maybe there's this stacker crowd I just mentioned, but also physical ETFs like the Sprott physical ETF, PSLV. You may be familiar with that. That has been a more pure form than the SLV, the traditional silver ETF of, basically buying silver, stacking it, and really stacking it, not using any paper, like no sleight of hand going on. And that's been picking up a lot of interest. And that may also have something to do with what's going on there. But essentially, the physical silver is getting drained out of the vaults. And at the current pace, maybe a year or 18 months out, you could well see a genuine silver squeeze. I think that's on my list of possibilities. I don't know what the probability exactly is, but it's definitely a possibility if that continues. So anyway, you've got a lot of things lining up with silver across different metrics of defining whether it's cheap. And, silver has often been a better indicator than gold when it comes to speculation in the sector, right? So if, with silver setting up, that certainly, piques my interest in terms of what might be attractive in that area. And then when you tie into it just where gold is, gold's Commitment to Traders report, its futures report is pretty attractive as well. Not quite as extreme, not 2018 levels, which was, right up there with the biggest ever in terms of lopsided positioning. But it's very close. It's very close. It's in the region. It's approaching it. And so you've got that, which gold would probably have to drop to 1,600 to kind of equal those kind of levels if I were to guesstimate, what it would take to do that. And it doesn't mean it will do that. It just simply, that's probably where it would have to go to match it. But the gold setup there is also pretty good. But one of my favorite, gold indicators, there's a lot out there. I know that Pento was talking about real interest rates, and it's true, positive or negative real interest rates definitely affect the gold price. One of my good ones is when the yield curve inverts. Okay, obviously that's typically a pre-recession indicator, right? But the moment that the yield curve comes out of inversion, starts heading up into now positive sloping, which essentially, if you think about what the mechanics are of that happening, it's where you have the inverted yield curve because the Fed has constricted policy, but then as it uninverts, that's because the Fed is now choking. So that's what that essentially means. Okay, so when that happens, the gold price usually pretty much all the time, it has really, really chunky moves to the upside. And so here we are, deeply inverted. The Fed is, sometime in the next 6 months are going to have to choke and stop the hikes and possibly even, talk about cuts. So the setup there for gold over the medium term, is pretty attractive right here. That's for sure. And it's certainly a very hated area. Whenever it gets this disliked, I just can't help myself. I've got to find something cheap, and there are some very interesting opportunities out there in the gold space, the gold silver space, in terms of individual stocks, and some interesting stuff actually happening today on that as well. If you want to talk about that.
Yeah, absolutely. I mean, of course, you predicted seeing $2,000 gold on our last call together before it had ever gotten there. So do you think this, the fundamentals of the case for gold have changed that much, or should we be sitting at 1660 as we are? Do you think the change that we've seen to this drawdown have been caused by the trading algorithms that take their other signals into account, like the strength of the dollar and yield curve and interest rates, as you mentioned?
Oh, for sure. I mean, there is a huge amount of program style, technical momentum-based trading, algorithmic stuff, which shoots a lot of these different asset classes all over the place, and it's hard to put a finger on, what exactly I'm supposed to look at to know when that's happening or not. Only that when there doesn't seem to be an obvious reason for something to be going up and down, you can usually just blame it on that. But that certainly is a factor. But gold, I think when you have at the extremes, does seem to present itself with some, does present some signals that are quantifiable. And right now we're certainly with silver as well, is you're starting to see the opportunity set up, and as I said about the yield curve. So I'm not too bothered about things like that because I can't really control them. I don't really know how to track them properly outside of looking at the commitment traders report, I suppose, where managed money could well also be, that portion of the futures port probably does include sort of system-based or algorithmic, futures trading funds. So I guess, there's something of that in there as well. But what's really interesting, I think, on the gold front is certainly in the last few months, some of the values in some of the individual stocks have started to get very, very interesting. The, 10 or 20% down, 300 or 400% up risk rewards, where you just don't see that kind of setup. But for maybe you had a few things in 2018 and 2016, and then before that you had to go back to sort of 07 and, to get, and then back to 2000 before that. So very rare to get, the kind of values that I'm talking about. And what's interesting today, actually, is an interesting situation. So Elliott Management, it looks like they've taken a stake in Kinross Gold, and also got with the CEO and the board and basically got them to buy back stock here and to commit to a return of capital over the next few years, which is terrific because, in that example, that company is trading at a very, very deep discount, as others are too. This one was particularly low. And, someone needed to come in there and give them a little nudge that, this is a capital intensive business. You're probably thinking about spending some money on a bunch of fun projects over the next few years. But you know what? Maybe put a pause on that, because the best ROI is buying yourself at this sort of discount. And so, the fact that a big player is now sticking their nose into the gold space and have picked this particular stock, I think that bodes very, very well for the broad sector. And that stock's up 8% today, so that's pretty good. So you're starting to see that this is the kind of thing which happens at bottoms. You start to see a few selective people show up and start sniffing around. I remember Soros bought Barrick at the bottom of 2016. That was that moment. I remember that. And so I'm always on the lookout to see if other people, maybe more well-known folks, are agreeing with what I'm already doing. And that kind of gives me a little bit more of a picture as to how that cycle may well be turning before our eyes. And, and this sort of spotlight tends to attract others. So we'll see if, with today's action, what that may mean in hindsight. But I think it's pretty interesting. We haven't seen someone do something like this in this sector for a while. So yeah, that's just one example. But there is a lot of value in the gold and silver space right now. Like, you can pick out a lot of different stocks where any reasonable forecast in the gold price equates to 2 to 3 times EBITDA valuations. And heck, if you think that gold's going to do something really interesting, then certainly a lot higher. And as far as forecasts goes, I guess I predicted the last time I said that the gold was going to go 2,000. In short order, it did. Well, I can say again that we will see $2,000 again sometime soon. I'm sure, probably over the next 12 months. But my personal target would be over the next 18 months that we see, maybe 23, 24, 2,500 gold. As the Fed chokes and they possibly have to reverse course on the QT and go back to QE. That's sort of down the line. The further away you go, the more cloudy the crystal ball gets. But I suspect that even if I don't know exactly quite how the acts play out, that's probably where we end up at some point within that period of time.
So, on the other side of, let's say, investing at the point when valuations are cheap and things look almost too cheap to be true here, on the other side of that, when we do, let's say, get to 2,500, you always want to be perceiving the market in an accurate way. So when we do get to those highs, what do you think marks a reasonable place to take some profits? Do you have any strategies around that to make sure that you don't forego some of those gains?
Yeah, you have to. This sector is wild. Okay, and there's certainly you've got to be disciplined. Avoid leverage, avoid derivatives, and don't get too greedy. Right? No, absolutely. I use a couple of things for that. I mean, I try and put it all together to tell me where I'm at, and one of them is just the gold price when it starts gapping a little bit to the upside, and people are getting way too much attention. If I tweet something out on Twitter with something to do with gold and I get a disproportionate amount of interest relative to my not particularly followed profile, if I'm starting to get way too confident about something, I'm like, okay, hang on a second, I'm probably getting too confident about this. It's probably time to sell. If my mother calls me up and tells me, hey, son, are you still interested in gold? I heard it was good. That's a huge sell signal. I've got a couple of clients who, can sometimes be contrarian indicators. So, if someone calls up like saying, why don't we own more? It's like, we already own a lot. Then that's probably another sell signal. So you'd be surprised, the sell signals which I use are very, some of them are a little bit harder to quantify. Some of them even include just looking online, when you're listening to other investors who are a little bit more vocal than I am, who I respect, and, I'll listen in and see what their opinions are on a few things. And if you start seeing anyone getting way too confident about something which has already had a run, then, again, that could be a signal. So, yeah, there's a number of factors. I mean, in the end, valuation is always my biggest thing, is that, if I want to be buying something for two or three times and selling it for 5 or 6, that's kind of the game plan. So, I'm always, disproportionately heavy when something's very, very cheap, even if it means I'm a little bit early. But, if we start to get into the momentum phase and valuations start to fluff up, I'll never be full position at the top. There's just no way. I'm just too conservative. I'll take something off along the way. And when it comes in this sector, honestly, that side of things, yeah, you do want to have a strategy, but the biggest thing is watching your downside, because you've just got to stick to companies where you feel they're not going to dilute you, because that's always the biggest risk in mining, apart from like a mine collapse or something, something jurisdiction-wise out of, which surprises you, is, these guys don't manage their balance sheet well, and then they dilute. And you've seen it across the board. A lot of these companies can be serial diluters, and that can really, really mess with any long-term plan you have, if they're not good stewards of capital. So finding companies that the balance sheet's going to make it, and they have some sort of growth profile, and they don't necessarily need to go to market for funding to get there at a point in the cycle like now where things are cheap and you think that the outlook is going to be stronger going forward, which it probably will be once we're through this window here, which may go on for another month or so, just, with the Fed and all that. Those are the investments which are going to perform the best, certainly on a risk-adjusted basis.
So as we're thinking about, let's say, the fundamental case for a particular sector, we've, of course, seen attitudes really changing towards nuclear energy. And you and I spoke about the overhang of the Fukushima disaster the last time we spoke. And it was recently announced that we will be seeing some Japanese restarts. So is there anything else that has made you more bullish on the uranium sector?
Yeah. So, when we spoke, uranium was like maybe high 20s, and then it went to $50, $60, and now it's around 50 approximately. Well, Sprott launched a physical uranium fund that's been mopping up physical uranium. And so you've had that, and it's clear now that we have definitely, that overhang of inventory is gone. Now, has there been a bunch of restarts here? Cameco have got a few things going again, which they'd shut down almost all their production at one point. But the smaller producers, this is still not a good price for them. Most of the small uranium explorers, they're not able to get going until $70, $80 uranium, maybe $100 even. It just doesn't make any sense. It's too capital intensive relative to their margins. So yes, what's happened with Japan is a good example. Is now they're going the other way, and now they want to restart the reactors. But the whole situation with Europe, and obviously the war with Ukraine and Russia, has brought to the spotlight the importance of controlling your own energy destiny and having an energy source like nuclear that doesn't require some large imports, because the amount of uranium needed to run these things is very small, relatively speaking, and can spit out a lot of energy and is clean and safe. So, the landscape for uranium has altered dramatically. You can already see it's happening. The final thing will be when Germany changes course and goes, actually, sorry, Greta Thunberg, we're going to have to build a bunch of nuclear reactors after all. So I'm looking out for that. That would be a signal. But the UK already announced that, we're going to build a bunch of these things, so, and it's coming in the US as well. You even saw it. There was a little bit of nuclear slipped into the latest bill that the administration passed, and you can even see with, whether it's Elon Musk or Bill Gates, whichever side of the aisle you want to pick, people who are listened to politically and have influence, nuclear is coming up in conversation a lot. There's a lot of, you could get into a whole debate on the whole green stuff and, what makes sense and what's stupid. And there's a lot, right? But nuclear is surely something we can all agree on that it's by far one of the most efficient, cleanest forms of energy when done safely, and don't build on a fault line or near somewhere where you can get a tidal wave. That's basically the rule. And so, yeah, the setup for uranium, it might be the best setup of anything that I look at over 5 years. Now, in what happens in between that 5 years, this thing is wild, and unfortunately, there's not a lot of high quality ways to invest in it outside of maybe buying that Sprott uranium fund. But I don't own that. I own some individual stocks, but I definitely really, really like it. It's one of those areas where it's, I've got some, and is uranium going to go to $100 in the next few years? Certainly within the 5 years. Oh, absolutely. High conviction that will happen. How it happens, though, is there like a massive financial crisis in between, and all assets get dumped before that happens? I mean, yeah, that's the thing with that. That's why, this sector is not that liquid, and it will get tanked more than others when you have that kind of volatility. So my view is I've got something, but, the next time there's a really, really big blow up and I see, some uranium names I like in the tank because of broad markets, being terrible, then yeah, I'm probably going to add, because I'd say that, relative to where we were before, I'd say probably the risk, certainly the reward sort of remains the same, but possibly sooner, but the risk has definitely changed. The risk, the downside risk is much improved than when we spoke before on uranium. So yeah, I think it's a question of when, and just, approaching it, while taking in this, as you can tell, this very bullish energy I have about it, but then also being, okay, yes, you're really excited, Mark, but timing is everything, as I said at the beginning of the call. So the older I get, the better I get, even this call, externalizing my ideas and hearing how I sound, I try my best to sort of balance that enthusiasm when there's a good idea and something I feel very good about, with the fact that markets can be very crazy and not do what you want when you want them to. So you have to take that into account with how you approach these situations. And yes, I like uranium, but I will wait for a really, really good time to get maybe bigger than I currently am.
Mm-hmm. Well, on the lines of talking about energy, we spoke about the importance of oil and natural gas the last time as well. And of course, we're now seeing the energy crisis develop in Europe. So can you lay out some of your investment thesis for oil and how much a part of the electric car future that oil still needs to play?
Right. Well, I think I mentioned on the last podcast that interesting slide that Exxon has, where they basically show that if everyone just went electric, just how much oil they still have to use. I think oil's not going away anytime soon, no matter what anyone says. And, the journey to electric is going to have all sorts of infrastructure issues and, capacity to build batteries and, lots and lots of stuff to go through. So it's going to take longer probably than people think. So nat gas and oil, that's a good topic, because last time we spoke, that was an absolute epic slam dunk opportunity, which we took advantage of. I'm not ashamed to say it. It went very, very well. The average investment in that area quadded, and I didn't even take that much risk. I was pretty, still a little concerned about COVID. I didn't go to the edge of the risk frontier there, and we still did very, very well. Now, where am I at with that? Well, I still hold probably about half of what I had then. Some of it got taken away from me forcefully because one of my investments got taken over, but the values in particular, I mean, to be honest, you're on oil as well, but I'm more focused on that gas, mainly because of the situation in Europe, and also because natural gas is, it's a little bit less cyclical than oil. You still need it to turn on the lights and keep everyone alive in the Northeast, so it's not going anywhere anytime soon. And some of the free cash flow yields on, the natural gas companies are still in the, the 30 to 40% variety, which is bonkers. I mean, that's just nuts. I mean, if that company existed, if I had enough money, I'd LBO some of these things and take it private. And, if someone could lend me the money, I'd be a billionaire before you know it. But so, some of these companies are just incredibly cheap still, relatively speaking. Now, the difference is obviously that they sound cheap, but that's with nat gas very high. So you have to dial that into it and go, okay, well, hang on a second. When it sounded like that, when nat gas was at $3, you're down, that was incredible. But, nat gas is, $7 something now. So it's a little different in that respect. But, on a free cash flow basis, these companies are still extremely interesting. And I think the nat gas and oil situation has got an interesting setup right now, because rig counts have actually started going down in oil anyway. Nat gas is just going up slightly still, and that's telling you that, okay, so $80, $90 oil, well, that's it. The oil companies in the United States they're not pushing the envelope anymore. They're not just going, that's it, we're just going to drill this thing to the moon and just let it collapse. They're being much more cautious. So you've got that going on, but then also the SPR release, so the Strategic Petroleum Reserves being drained, right, as part of the administration strategy into the midterm. So even though gas prices are actually no different to they were before the conflicts, with Ukraine and Russia, they're still basically draining our emergency fund for political reasons, right? So it's pretty ridiculous, to be honest. But, at the current rate going into when they're going to wrap it up in October or November, it's going to be down to under 30 days of supply in the SPR, and will be at a 40 or 50 year low, something like that. And so it's going to be, the military won't let them drain it anymore after that, because at some point, if there really, really was like a problem in the world, you need the strategic petroleum reserve, for lots of reasons. So, but that wrapping up is going to basically take 1 million barrels a day of supply off the market. And it's interesting that after, Biden went to meet Saudi Arabia, they didn't increase production. They actually cut production by a tiny amount, by 100,000 barrels. So it tells you that, okay, the Saudis aren't going to put any more in while this is going on. And once this runs out, as long as demand is still there, and, if the world hasn't fallen apart by then, and, who knows, maybe China comes back online, that could be a surprise demand story to the upside, right? I don't know about that. It's just a possibility, right? You've got that happening, but then also natural gas exports out the US, while they're at a record, have actually been curtailed because there was a problem with one of our largest exporters, the Freeport LNG facility. They had some issues and they're fixing them now, and they're expecting to be back online, like 95% of it, by November. So right at the time that the SPR stops being drained, we also get to start exporting more natural gas again, which obviously Europe wants to gobble up because Russia's not sending them anymore. So you've got a setup there where energy might start getting tight at the wrong time into potentially a cold winter in Europe and the United States. And, as long as demand's still there, all things being equal, this has the smell of a potential spike in energy coming in here. And, given that the valuations are still good, you've got Buffett buying up Occidental Petroleum, like he wants to take over the whole thing or something. I don't know what his end game is there, but he keeps buying it, and he's got authorization to buy a lot. And then, as I mentioned before, the free cash flow yields on some of these companies are still sound very compelling. So you've got a setup there where essentially the stocks look cheap. You've got big people coming in. Their relative performance right now versus the S&P, if you look at like Exxon or Chevron, just like big companies as an example, right? I don't own either. It's fantastic, right? I mean, they look great. They look like they're being accumulated, is what it looks like. So you've got a setup here where energy is being reaccumulated. It was in the dumpster. The valuation is still good. The SPR is going to run out. The LNG is going to come back on right at that moment, that we're probably past the worst of the Fed, and that you might be into the zone where they're talking about, now they're going to start to calm down a bit. You've got a setup there where you could have a lot of money fly into this area. And, if there's an energy spike, which maybe takes energy back up to 120, 150 on oil, that is, that's an interesting setup I have over the next 3 to 6 months. It's a short-term situation. We'll see what happens, but I think it's a possibility. Kind of reminds me of sort of beginning of '08 with what happened to oil there, and then look what happened afterwards, right? So, you have to be aware of that it might be short-lived, but I think it's definitely on my list of things that can happen. And disclaimer: this is all within the context that we are mid to late cycle of this particular move here. This isn't like when we spoke before, where it was just like, free money. This is, it's definitely a little bit more of a cautious stage. I'm still in there. I still like it, but I'm aware that this is not, the downside is much larger this time relative to the upside. So anyhow, certainly very interesting. And I'll add on one other point, was that, when I'm making lists of different types of scenarios, right, because you're trying to come up with different ideas and see what works and what doesn't, and kind of be prepared for different things. But on my list of what's going to be a neutron bomb to blow up the whole system, one of them was what was going to happen to energy and civil unrest potentially in Europe between sort of December, January, February. And that was a very, very big risk, given the fact that if people can't even turn on the lights or can't, spend so much money on their fuel bills and their energy bills that, maybe they stop paying their mortgages, or they start stealing food, or it can get bad quick. I mean, we've seen that, how quickly a society can get rattled given certain criteria. But I think that the politicians of Europe have already figured this one out, and they don't want to get pitchforks and dawn, at the front door of the various parliaments. So UK already, basically issuing money to bail out people and capping their energy bills, and different countries in Europe are already doing similar things. So they're already anticipating that. So I'm wondering if that's been taken off the table, that particular disaster for the moment. But we'll see. But either way, that does tie into another issue, just that, government's printing more money, adding to the inflation fire to basically pay for a problem they haven't really fixed because of their policies prior to this. So not really fixing the problem, just band-aiding it and hoping it goes away. Yeah, a lot of interesting things going on there too.
Yeah, absolutely. And I think that just goes to reinforce the importance of really reliable energy sources. And then I hate to see saying that we've seen how the consequences of the playbook of giving people money to whatever it is, pay for their lifestyles during lockdowns and or paying their utility bills once they're, getting out of hand. I think that's going to have the same outcome, right?
Right. Yeah. And you wonder if this all ends up with some sort of universal basic income, end game. I'm not sure. It's definitely the governments of the West are being very reactionary right now. They're not really taking the long view in terms of what it's going to take to to fix a lot of the structural issues out there and make a policy that's going to benefit everyone for the long haul. It's very sort of short term. I think that when you're last, I mentioned Pento again. I love that guy, by the way. He's super smart, very wise guy, and very successful. He mentioned about the student loan deal. So I won't repeat the analogy, but we're on the same page on that one. Just putting fuel on the fire there and not actually addressing the problem. I mean, it's just unbelievable. To the outside seem fairly obvious of how to fix, but somehow don't get fixed and just get worse.
Yeah, absolutely. And I mean, we could spend, I'm sure, hours speculating on scenarios of possible outcomes of this, but I'm sure the nuances will reveal themselves over time. Mark, why don't you share with our listeners where they can find more from you?
Well, I work for Pine Valley Investments now. I am on LinkedIn. You can find me, Mark Magarian. That's probably the best way to do it. I think my profile is open. You can just send me a message if you want to have a chit chat. But yeah, I think that's probably the best way to go. Excellent,
Mark. I appreciate your time, and we'll have to do this again and to kind of get the contrast and the perspective the next time we speak.
Absolutely, Tom. Really appreciate it, man. Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.